Welcome to Businessline's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello and welcome to Businessline's State of the Economy podcast. This is the personal finance podcast that will be done every month. My name is Aarati Krishnan. I'm a consulting editor with the Businessline and I will be anchoring this monthly podcast for you. For the first episode of this podcast, we are pleased to have with us Mr. A. Balasubramanian, CEO and Managing Director of Aditya Birla Sun Life Mutual Fund. Bala is one of the real veterans of the Indian debt market and has been tracking it for nearly 3 decades in capacities as a fund manager of debt mutual funds, chief investment officer, and today he is the CEO of Aditya Birla Sun Life Mutual Fund, where he's held this position for over 10 years. So Bala has been tracking the debt markets from the time when small saving schemes used to offer 15% interest rates and companies used to borrow at 20%. So let's hear Bala on the recent developments in the debt investing space.
So to start with the hot topic, yesterday's monetary policy. I think the market was a bit surprised by the fact that RBI decided to pause the rates. But the bigger question, I think, for investors in debt and for depositors, etc., is this the real end of this rate hiking cycle, or should we all be prepared for rates to go up a little more? Because I think they have left the window open, no, saying that if inflation goes up, then we may consider further rate hikes. What is your view on?
I think first and foremost, I was not surprised on the RBI move. I was of the opinion that things are a lot more under control for RBI to take a pass. People do look at every time Fed has increased the rate, therefore RBI also increased the rate. And if you look at the pace of increase in the US, it's almost about 450 basis points. And pace of increase in India is substantially lower than that. So we have raised only by 250 basis points.
Right.
Whereas US has been quite substantially higher than us. And the reason is RBI has been looking at our data points, which is domestic data points. And what are those data points? Clearly looks at currency, how currency has been behaving. A lot more under control compared to the last quarter. This quarter, current account deficit has improved. Second is inflation is marginally higher, but it's too early to jump the gun saying inflation will hurt at this point of time, given the fact the food inflation and core inflation have gone up marginally. At the same time, need to be considered, rather need to be looked at on the back of the drop in commodity prices in the last 1.5 months. Second is food inflation is marginally has gone up, but also need to be looked at from Rabi crop output point of view. And then how the next crop preparation is happening. I think it's too early to take a call, El Nino effect and so on and so forth. The preparation for next round of cultivation, I think is going in a full swing across the country. Given the general water dam levels in the country is quite robust. In the sense, dam levels in terms of actually to supply water for the next year, it still remains good. So keeping all those in mind, I think RBI was not a surprise for me. And in terms of rates, I think there is general feeling the peak interest rates we already peaked. But thing is that is only calling the rates. I think there is no such peak or it's not like a trough or bottom types in the market that we always say.
Right.
So the peak interest rate regime, 6.5%, we keep saying is this peak. But I think RBI never has said there's a peak rate. RBI will always keep their options open. Okay, for them, there is no peak or low. I think for them, they have to keep their options open. What governor has mentioned, keeping the options open more for the market to form on expectations that immediately either they will not hike it or they will not reduce it. Either side, they are not allowing the market to have that assumptions.
Right.
But my personal belief is I think raise interest rates substantially, and the real impact of that will start reflecting one on the growth outlook. Second is moderation in inflation also have to come along with that. The job losses in US continues and wage growth comes down, and the slowdown that happens in US to start with. Again, the commodity prices generally remaining weak. I think it continues for a little prolonged period of time, though there is a OPEC cutting down the production will lead to increases. Generally, I've seen cutting down production shows a weakness. It doesn't show the strength.
Okay.
So if I have to consider the weakness, then there is no reason why oil price has to spike up.
Okay.
So that is being the case, there is high probability the current interest rate regime, we can call it as higher for longer, but higher for longer could remain.
Okay.
And instead of cutting in a hurry, as we start seeing the inflation moderating,
Right.
they will not cut in a hurry. They will allow it to stay where they are today for a little longer of the whole of 23-24. And in terms of further rate hike, I think looks to be difficult. Even in the US, even US also,
Right.
my own gut
Right.
feeling is incremental rise in rates, policy rates, I'm saying, may not happen. And India also, my own belief is incremental rate hike will not happen. If at all, it will be a pause for long, and then reduction in the year 24.
Right. So today, after a long time, actually savers are seeing high interest rates on bank deposits, on small saving schemes. Recent revisions were there. So do you think people should try and lock into long-term options at this place, or everybody loves to wait for the market interest rate to hit 8%, but that never seems to happen?
Correct. I think from a saver's point of view, say whatever said and done, the current interest rates, at least the real rate of interest on this is actually about 1.5% you get.
Right.
I mean 6% inflation.
Right.
And if I get about 7.5%, 8%, definitely is not a bad rate at all.
Correct.
So therefore, to the extent savers have to look at locking their money for long term.
Right.
That's something which I think it's worth doing it, because if you take the compounding effect of this for a period of 3 years or 5 years, 7 years is far higher. Second is, people may argue that equity may give better return, which is fine.
Right.
But equity also, if interest rate is about 8% and GDP is about 6.5%, then equity return would be roughly about 11, 11.5, 12%. So the significant alpha that you otherwise you get in equity is also reduced at this point of time.
Right.
Therefore, it makes more sense to look at long-term debt
Right.
from a saver's point of view. Whether it they go to deposits, and maybe if somebody is giving a 10-year deposits, it's worth locking in for him. And if I get a 10-year bond, is worth buying and keeping it for that matter.
Right.
And if you look at mutual fund, even after the LTCG going away, and if you have a longer term money, it's worth locking in. And given the fact the rates are elevated level, and as the interest rate starts coming down, then naturally the savers generally that is the time they start thinking locking in. I think the savers should always think about locking in for long term.
Right.
When the rates are high.
When they start falling, then there is a scramble to go and lock, right?
Yeah, if there is a fall, then banks, they will also start reducing the deposit rates. The general tendency for savers is always to go and lock your money the moment I say I'll reduce interest rate for next week onwards. Or the moment I say my interest rate is reduced.
Yeah.
So that is the mentality of most of the savers. My own belief is when the rates are being high and they chase you also for money, that's I think best time to lock in, because there's a need of money for the borrowers.
Right.
And as long as one has got cash flow known for long term, then it's always worth putting in money at that point of time. Even in the fixed income, I've seen the past being very muted or negative is always the best time to invest in bond market.
Correct.
Because all the mark-to-market laws get adjusted.
Right.
Therefore, to the extent portfolio yield goes up.
Right.
And the portfolio yield going up means my accrual is for longer.
Right.
And then mark-to-market gain or loss will come. So that's the way I always historically look at the bond market investors in the mutual fund schemes.
This is like, usually people find it difficult to understand this inverse correlation between bond prices and interest rates. But this is like actually buying into stocks after prices have fallen, right? So when past returns on, say, gilt funds or debt funds are negative, it shows that bond prices have fallen a lot and yields have gone up. So that is a good period to buy. When past returns are in double digits, it shows that a lot of rise has happened in bond prices, and that is not a great time to buy. Right. That is
exactly. I think that's a simple way of analyzing it.
Yeah.
Which is I call it as a common sense kind of principle.
Yes.
I think if you apply that itself, I think people can jump and buy.
Yes. So you talked of people rushing to put deposits before the last date and all. The same thing has happened with debt funds, I think, with these changes from April 1st. Actually, the long-term capital gains benefit on debt funds has been removed. So you won't get indexation if you hold debt funds for more than 3 years. So before March 31st, there was a big scramble to go and invest in debt funds. And now there is a fear that after April 1st, people will shy away from debt funds. So do you think debt funds, the case for investing in debt funds has been eroded a lot because of this tax change?
See, first and foremost, because of tax benefit, we didn't get big money in any case. Though the tax benefit has been there for quite some time. The retail investors would have come. Had it come from tax benefit, the industry would be sitting on about 2 times higher than the current industry size. So that is one way of looking at it. Therefore, people have come for variety of purposes. It has been offering the solution, which is been the asset allocation model in which people have come. So definitely the added advantage that they had, which is basically the indexation benefit, and the long-term capital gain tax.
Correct.
Just for indexation, it comes to 20%. Therefore, the tax alignment was used to go to 8-9% kind of things. So that's definitely gone away. But having said that, at least unlike deposits, where every income that is generated is taxed at the rate of every year it taxed. Whereas in the mutual fund, you'll have tax only at the time of redemptions. So it's basically as and when you redeem, that time the tax consideration comes. And second is whatever the income that comes in mutual fund, it comes in the form of a growth.
Correct.
So essentially, it comes in the form of capital gain. Therefore, you have to pay the short-term capital gain tax. The short-term capital gain tax is linked to your tax rates.
Correct.
So individual taxes. Somebody will pay 15%, somebody will pay 20%, somebody will pay 30%. They have to pay that tax rate. So therefore, to the extent it will not be too much discourage people to come in. I think if somebody is still convinced, they can come. And third is where do you capture the interest rates movement in a live basis? So I'm a believer the biggest advantage of mutual fund. If the interest rates moves up, where does it reflect for the consumer savers point of view immediately, then and there?
Correct. Correct.
It is a mutual fund.
Correct.
Whereas whatever you put in deposits, and it doesn't reflect the interest rate movement that are prevailing in the market.
Correct.
So actually, you have locked your money, therefore they get what you get. They give you what they have promised you. Whereas let us assuming scenario, you locked your money at 7% in deposits, and now interest rate has gone to about say 9%.
Correct.
Would you be able to capture that in the bank deposits? No.
You can't.
But can you capture this in the mutual fund fixed income scheme? Definitely the answer is yes.
Yes.
Because my lending, whatever money comes, I'm lending in the market at the prevailing interest rate to a borrower.
Correct.
Not to the depositors. It's a little reverse.
Yeah.
Therefore, I always get the benefit of me as an individual instead of me as a lender, which I cannot become a lender. But can I be a lender in the market or investor in the market on various bonds? The answer is yes through the mutual funds. That's why I think mutual fund acts as one of the resource for the borrowers through the public retail money. Therefore, the relevance of fixed income schemes will remain. The tax advantage, which of course has gone to the extent it disincentivizes people, no doubt. But again, if you look at objectively the safety, liquidity, and the return which are linked to the market, if you look at from the angle, say on a 5 or 10-year basis, taking into account the compounding that it can generate, say either 7% return or 8% return or 9% return, whichever bracket in which it falls, I think it will still remain as relevant as an asset class. So only thing is we had some kind of, if in the pecking order, if we put it, we were always used to come automatically on the top because of tax benefit.
Correct.
So now that is being taken away, but that doesn't mean the relevance goes off significantly.
Right. And you also get anytime liquidity, right, with open and mutual funds. So
yeah, exactly. There is no prepayment clause. There is no,
nothing.
you don't need to go and ask bankers and so on and so forth. And you don't need to depend on market liquidity.
Right.
So yeah, we give an instantaneous redemption that we provide. And from an investor's point of view, is a nomination, if you put it, is something untoward happens. Process is very simple,
Correct.
easy process. And therefore, mutual fund will remain, the edge that mutual funds have got will remain. People always say there is a mark to market, therefore I want a stable, steady return. But fixed income is one instrument, you give time, it gives a steady return. If you don't give time, it doesn't give you the required return that you may have in your mind. But when I give time in 3 years, if I give time of 3 years, the curve will be a little fluctuating, but it will be linear curve. It will be fluctuating.
Right.
So that's the benefit that mutual funds provide. That relevance, in my view, will remain.
Right.
Plus, other thing also that people think actually, if I put money in mutual fund, fixed income, I had to withdraw in one go. But nobody withdraws money on one go for the purpose of any requirements. I think the beauty of mutual fund would be a systematic withdrawal.
Okay.
Without any pre-closure. If you put money in deposits, it all comes in the form of pre-closure.
Correct.
Whereas the mutual funds, you can withdraw only to the extent of what you want. So the moment you withdraw only what you want, in that capital tax element is very least, because there almost about 90% will be the 95% or maybe 98% will be the capital component.
Correct. Which
And
won't
the
be
balance,
taxed.
correct. The balance will be the income component equivalent, which will be the under tax element will be very, very small. So though you'll end up paying still 25% tax or 30% tax, which was tax bracket when you come. But on a monthly basis, when you do a withdrawal, the tax incidence is the least.
Right.
By any chance, assuming scenario, medium HNI person, or maybe, or I've been good tax planning which I'm doing, and we have by any chance capital loss, short-term capital loss, you can adjust against the short-term capital loss also. The short-term capital loss could either come from securities, or come from real estate, or come from the trading in the market. So such kind of capital loss can also be adjusted against short-term capital gain.
Right. Right.
So there are ways and means of doing it. Only thing is we're all expecting a faster growth to come in the fixed income space because of the tax benefit and rates where they're high.
Right.
And the differential attraction between equity and fixed income, with fixed income becoming one of the most attractive asset class today.
Yeah.
We were hoping that we'll be able to grow the industry much faster, given the fact that 70-80% of the population in the country still depend on fixed income oriented investment opportunities through fixed deposits. That could potentially become one of the target segment for mutual fund. That still remains, but the rate of growth to the extent of change in the requisitions would come down.
Right. So when choosing a debt mutual fund today, which segment is looking attractive, sir? Because there are gilt funds, target maturity funds focused on government securities and state government securities. Then there are corporate bond funds which invest in high quality corporate bonds like AAA and AA. Then there are credit risk funds and first funds, medium duration kind of funds which take some amount of credit risk like AA rated securities, etc. So where do you get the best risk reward today if you look at the market situation?
See, as it stands today, definitely the open-ended actively managed debt funds like corporate bond fund or dynamic bond fund or the credit fund would be the most ideal for one simple reason. One, these investments will be made between G-Secs, AAA and AA minus kind of securities. Therefore, potential risk coming from the credit is taken care.
Right.
And secondly, if I have a little higher credit exposure, which is basically corporate bond exposure, they generally tend to borrow at 30-40 basis points higher than the same maturity government securities bonds or T-bills.
Yeah.
So 40-50 basis points, you get a yield kicker. And third is, assuming scenario, the interest rate hike that has happened in the recent past, and there is a huge demand for money comes in from a credit offtake, big time, then there also spread widening also will happen. Okay. This year, you'll see government borrowing program will start.
Correct.
As the government borrowing program starts, the yield generally moves up when the credit market picks up. The borrowing cost increases, therefore the credit increases. The mutual fund money manager generally capture this by investing in the corporate bond, and which is comprising of AAA and AA minus kind of things. So therefore, from investors' point of view, if your time horizon is longer, then one must choose this. The target maturity fund, it's I call it as a bit of lazy investing, because you come for a certain period of say 3 years or 5 years. I don't do managing damage. I don't do dynamically manage the funds, and the extent is more like a buy and hold kind of things. But the fixed income one has to capture and stay invested for long term and capture the interest rate movement at all point of time. It is the dynamically managed funds, which is basically comprising of corporate bond fund, 2 to 3 years or 3 to 5 years kind of durations. Medium term plan, which again 2 to 3 years kind of durations. Go across all credit market and dynamic bond fund or credit fund. So these are 4 asset classes one should look at it. But of course, not the last but not the least, within the fixed income category, it's called equity savings fund,
Correct.
which invests roughly about 38% in equity or 36% equity, and balance comes in the form of debt, or even balance advantage fund kind of things, which invest roughly about 40% equity, and it increases exposure to equity depending upon where the equity market moves. If somebody's got long-term time horizon, and those funds also could actually serve the purpose of fixed income investing with some portion of the equity coming in. Over a period of 10 years, this kind of mix delivers a little better than the fixed income schemes, but a little lower than the equity schemes.
Correct. And you will get indexation benefit in such schemes.
Yeah, in such schemes, you'll get the indexation benefit as well. That is the new thing that probably will evolve. I also believe that because of these taxations coming in, this hybrid asset class, which has got a huge merit for it to be large in size in the customer portfolio, would start gaining some attractions as an alternate to traditional fixed income mutual fund investing, with some allocation going there.
Right. So one thing that many slightly sophisticated or HNI investors are doing today is they're looking at this portfolio yield to maturity of debt funds. So this is actually for the benefit of listeners. It's portfolio yield to maturity is the average yield of the securities held by a debt fund. So they seem to think that suppose the portfolio yield to maturity is say 8.5% or 9%, then I should choose that fund over another fund for which the YTM is less. So is this a good approach, and is the YTM really a good indicator of future returns?
The YTM is the one generally used for the pricing of the bond. And therefore, YTM is one of the considerations that one should look at it. Second, of course, quality. If the average YTM says about 7%, and suddenly somebody is giving 9%.
Correct.
How is different? It's different because he's gone down the credit lines and the credit curve and basically taken a risk which is higher than what others would have taken the risk.
Right.
Therefore, one has to just measure the risk like this.
Okay.
So once you're done, I think YTM is ultimately is the rate at which on a daily basis the NAV is calculated. So therefore, to the extent the true indicator that we should look at it. Second, the fixed income schemes, there are 2 components which are for the database NAV. One is the YTM or the coupon, whichever coupon is at which your accrual happens on a daily basis. Basically, the interest to be received from the company in which you have made an investment in the bonds, that's the interest accrual happens every day basis. Whereas the YTM reflects the mark-to-market component also. That component is generally not very high. It's about roughly about 15-20% will be the mark-to-market component of the NAV calculation, and rest 80% to the accruals. If I have to take this as a cushion, the 80% is a cushion for the portfolio return for the long term. With that coupon, irrespective of what happens, coupon always come. But the price movement, depending upon the YTM, depending upon the interest rate movement, either can give a substantial gain, it can also give a substantial loss. But still, since a large component of the NAV come from the coupon accrual, the portfolio gets the necessary protection on an ongoing basis. That's why if you look at fixed income schemes, even after losing credit loss, even after having credit loss, even after having mark-to-market loss and rising interest rates in a year, they're not given a capital erosion because a large component NAV is also coming from the day-to-day accrual of coupon.
The longer you hold the fund, the more is this coupon component, right? Which is coming.
Correct.
Which is why you say that when you hold it over the long term, you will get a smooth return, whereas short term, this price fluctuation will be affecting your returns quite a bit. Right?
It can actually make you disbelieve. That disbelief, in my view, is something not warranted.
Right.
Yeah.
So now, if you see after the latest revisions, even small savings schemes offer pretty good returns. For example, the senior citizen savings scheme offers 8.2%. NSC is offering 7.7%. So how should an investor actually mix investments between, say, bank FDs, small savings schemes, and debt mutual funds? I mean, how should this allocation be decided?
See, somebody doesn't have, of course, much of tax-related worry, like senior citizen and others. They must avail the benefit that they are getting. from the fixed deposits. Because they get additional 20-30 basis points they get as a senior citizen.
Right.
Even Government of India is giving through the postal saving deposits, almost about in a year, they have pretty large sum of money being raised through the postal deposits, which again being part of the fiscal.
Correct.
To the extent that they must avail it, as long as they have within that tax consideration.
Right.
But in addition to that, whatever money they can commit, then they can come to the mutual fund. But again, apply the same principle as you apply for 10-year or 5-year NSC. Because what people do is when they go to savings account, saving deposits offered by post office, and there the tenor is very clear, 5+2 or 5+3 types.
Correct.
Therefore, there they commit for 5 years.
Correct.
But when it comes to the question of deposits, they choose only 1 or 2 years or 3 years. They don't go for 10 years.
Right.
So that decision, I think they have, in any case, keep in mind in their decision-making process point of view. After exhausting these two things, for taxpayers, it doesn't matter. I think taxpayers, you can go to any other, because anyway, the tax remains the same. But all taxpayers should avail the benefit of STCG benefit. And that's something you should keep in your mind, because we always think we'll only make profit all the time. There is a period where we'll make a loss on somewhere.
Correct.
So, but the loss, if it comes, can you do your tax planning at that point of time using this capital gain that comes in fixed income schemes? We must use it.
Right.
The Government of India gives very limited option for tax saving options. So that we should use it because it's a legitimate right of me to use that. Yeah.
So what you're saying is the returns that you make from debt funds are always treated as capital gains, and now they are treated as short-term capital gain. Because it's a capital gain, if you're making a loss on your other shares or other investments, the set of possibilities there. Whereas on your deposits or small savings schemes, when it is taxed as your income. It is not taxed as capital gains, right? So that set of possibilities.
Every year basis.
Correct. Every year you will be paying tax. Here you will be paying tax only if you redeem and you take out.
Exactly.
There also you've offered a good idea, saying you no need to take out all your money from debt mutual funds if you don't need it. You can do a systematic withdrawal, or you can withdraw in phases whenever a need comes up, isn't it?
Correct. Exactly.
Okay, thank you so much, Bala. I think we are at the end of our session. It was a very insightful session indeed, and I hope investors have a lot of takeaways from this.
Thank you, Aarati. It is my pleasure to be part of the show hosted by Businessline and yourself.
Thank you.